Welcome back to Gimme Some Truth. We have a topic today that is maybe not the most exciting topic in the world, but needs to be understood for those that it affects because it is very important, as we've seen for a lot of our clients in their overall financial plan. That topic is equity compensation, also known as stock options, stock compensation. There's a lot of different ways that we describe it in our industry. We like to have 12 names for the same thing in our industry.
That's
and
right.
then also build some acronyms in too, just to really screw people up.
No nomenclature at all.
Yeah, it's not a foreign language at all. It is. Mitch is our one of our resident experts in the firm on equity compensation, and it affects, what's interesting is it affects a lot of people that are very local to this podcast, in our same county, if you will, but it also affects people that are all over the country. It affects people that are all over the world, frankly, because this is becoming a very popular compensation strategy for people, especially for higher wage earners and for people that are working for companies that are trying to keep them there and not have them move to the next IT company or whatever it might be. So Mitch, help us understand a little bit about this topic, equity compensation. What is it? And just kind of what does it look like today, right?
Yeah, so it's part of your pay package, we'll say. So it's pretty common that you're going to get some sort of base salary, right, to show up to work every day. Might be a cash bonus. And a lot of times this might be a cherry on top. So when I say you get granted an option from your employer, what that means is basically at some point in time, you might have the option to exercise your contract and buy company stock.
Sure.
Basically. So at its most high level, an option allows you to buy stock at a predetermined price.
In the future.
In the future.
Yep.
So that predetermined piece is important because you get your grant and it says a price on there, $10 a share. Great. Oh, well, 7 years from now, the price is $100 a share. Oh, sweet. I can buy stock for $10 a share and turn it around and sell it at 100. That sounds like a good deal. So an option, we'll get into a couple flavors of it, but an option allows you to buy that at a predetermined price.
And it expires at some point.
It does.
It may not ever hit that price.
I've seen these things go underwater and people get $0 of value from them. And actually, if we look back at Microsoft as a case study, Bill Gates, when he was figuring out their comp package for early Microsoft employees, he and I'm going to butcher the quote a little bit, but he basically said, like, the options were great, but it allowed my employees to either send their kids to college 12 times or not send their kid to college at all.
Sure.
And so it kind of shows that these things very well could be $0, right? And especially if you're at an early stage company, if you're at a private company with really no market. Now, Microsoft now, of course, publicly traded, right? But if there's no market, yeah, you might just have a piece of paper that's worth nothing when it expires.
I think your way of describing it in the intro was perfect, which is the cherry on top, right? I think that's the exact way, because of the fact that these could be worth $0 today, tomorrow, and 20 years from now, to look at it that way, right? The cherry on top. This should not be considered the bell cow of your retirement plan.
Right, exactly. And we certainly have clients that have $0 options. We have clients that they're worth something. So there's going to be a spectrum there where if we can pretty reasonably expect on getting some value from it, great. We'll incorporate that in your financial plan. We'll still take a conservative approach to it. We're not necessarily going to continue to assume that your company has this hockey stick growth and they're growing 20% a year, right? We're not going to assume that. So we certainly can account for it. It's real. There's tax issues. So tax planning is going to be a big part of it. And then sometimes you don't want to let an option expire when it is in the money. So there's also some pitfalls that we'll get to at the end of the podcast too.
So we went through some of the kind of flavors of options. What are let's stick to the 2 or 3 most common types of options. Let's start to go through a few of those and speak a little bit too about the taxation of each of those.
Yep. So the 2 options that you see are non-qualified stock options or incentive stock options. And as far as who can receive those, there's actually a subtle difference. So if you were consulting or a contractor for an employee, you can actually receive a non-qualified option. So if you're doing work for insert company here, it doesn't matter, right? They can grant you a non-qualified option even though you're not a W-2 employee. So that's one difference. An incentive stock option generally can be a little bit more tax advantageous to you if things all go according to plan, which means you hold it for a certain amount of time, the stock actually grows, right? All those things. But with an incentive stock option, you can get all that growth with a favorable capital gains treatment, which generally is going to be a lower rate than your ordinary income tax rates, versus a non-qualified option. When you ultimately exercise your option, which means, okay, I'm going to buy that stock at $10 a share, right? That predetermined price we talked about. The spread, what you call it, so price is at, let's say, $15 in this hypothetical, and stock prices, or the strike price was 10, there's a $5 difference per share. That $5 is subject to taxation at ordinary income rates. So
in the year that you exercise it.
Yeah, so that's going to be one of the biggest differences on the tax side between incentive stock option and non-qualified stock option.
So obviously knowing what you own is a huge piece to the puzzle.
Let's start with the basics. Like, if you don't know what you own, figure that out. Look at your grants, run it by a professional. Some people just say, oh, I got these grants, I signed it, great. Okay, I've got options.
Yeah.
Okay, what's your strategy?
Right.
Figure out what you own, because it might be, I've seen people where they have both. Incentive stock options, non-qualified options, then they might have all the other flavors of equity comp. That's not the purpose of this conversation today, but understand what you own, understand the timeline, because a lot of times these things will be staggered because you get one grant 1 year. Next year you get another grant. Next year you get another grant. Okay, you vest over time. Vest means that you basically have the right to exercise your option. I don't know if I defined vesting. But then all of a sudden you get these multi-year approaches, and then they start stacking on top of each other and different expiration dates, and having a coordinated plan on when you exercise, when you sell, ultimately dispose of the stock that you purchased. That's going to get more and more complex the more grants that you receive.
I think it's fair to say that some of our most complex financial planning cases for clients have been people that have layered equity compensation within their overall plan. Is that a fair statement?
I think so, because there's tax things that come into play, and I briefly defined a little bit on some of the differences with incentive stock option, non-qualified options. If you have incentive stock options in particular, something called the AMT can creep into, and for 99% of taxpayers, AMT doesn't mean anything. It means alternative minimum tax. And that effectively is kind of a parallel tax system where you file your 1040, you do your taxes every April. It says, here's what you owe, or maybe get a refund, right? And pretty straightforward. AMT is this way that can affect some high income or wealthy people where, okay, if you just deduct, you itemize your deduction and you pay such a low tax liability, then the IRS is like, hold on, let's look at AMT over here. And then they run the AMT calculation and say, no, actually, this is the alternative minimum tax that you pay.
And it might not even be somebody that's wealthy. It might be somebody that's just exercised a whole bunch of stock options in 1 year.
Precisely.
And put themselves in a really bad tax situation for that year.
In particular, the incentive stock option. So it doesn't even matter for non-qualified options. That doesn't affect AMT at all. But in the year you exercise an incentive stock option, you might be subject to AMT. To tie this into much more recent news, right, with the One Big Beautiful Bill Act, the SALT cap increased. More people are likely going to be itemizing again. That actually might hinder your ability to exercise your incentive stock options, or it might reduce the amount that you'd be willing to without subjecting yourself to the AMT. And that's just a way that the formula works, right? So if you add back your itemized deductions when you're doing your AMT calculation, oh crap, I wanted to exercise X amount, but now in order to avoid that AMT, I'm only gonna, do X minus Y.
Yeah, in a lot of these cases, we're working closely with accountants and tax preparers to
Yes.
understand the amounts and to have a plan in place. So this is a kind of multi-front approach that we take, not only from a planning standpoint, get tax advisor involved. Obviously, the client has a huge impact on what they want to do. So these become kind of decision by group, if you will, because that generally yields the best result. Clint, we've seen a few pitfalls for our clients when it comes to equity comp. I mean, help people understand what a few of these pitfalls might be, or maybe even just the most common one. And I'll ask Mitch the same question, because as good as these are, boy, there's some there's some landmines out there you got to be real careful of.
Yeah, I think one of the most recent examples that we've had is just people not planning out their exits,
Sure.
and figuring out when to leave in concert with a vesting schedule. So a lot of decisions that people make tend to be emotional when they're trying to leave a position. They're kind of done,
Sure.
and they may leave some money on the table. They may not have planned out their exit strategy very well, or their exercise strategy very well. So, and then I think keeping track too is one of the things that's difficult for people. A lot of times there's software that we can look at some of those, but sometimes we reconstitute that into spreadsheets, and just be able to look at it a little bit easier and be able to go through it with a client. I mean, like you guys have indicated, this is complex, and year by year, the tax situation could change significantly. So it does take a lot of planning there and coordination between accountants and advisors and the clients. And oftentimes the client really doesn't understand it. And that's great. I mean, that's fine. That's not what they're paid to do, but we need their buy-in too to be able to exercise at certain things, because there's emotion built into a lot of this employer stock.
Yeah.
So, we want to be careful too as well. There have been situations in the past, Enron and others, where they had large amounts of equity compensation that was sitting there on their books, and it was a large portion of the retirement. And if people didn't take some of that off the table, you could have a really dire situation from one that looked good one day, and then the next day they wake up and it's really bad. So you just have to plan that out. And this is where I think people really need advisors.
Yeah.
They need advisors when you have a significant amount of equity comp. You need the services of professionals in your life that are going to help shepherd you through these and work collaboratively. Mitch, do you have any examples of client situations you may have a pitfall in there that you saw?
A couple. I would say someone that's way too eager to exercise.
Interesting.
So,
or somebody that goes, "Hey, I exercise. What do you think about the decision, Mitch?"
Yeah, right. Exactly.
Seen that before.
So when I say way too eager to exercise, usually that's going to be referring to a company that is private. So let's say it's a startup, and they might not be able to afford to pay you a real strong base salary, right? They give you a smaller base salary, but then the extra incentive is through options. So you got these options. Okay, great. I vested. I'm now able to exercise, and people get all giddy because they're like, sweet, I've got these options. I can exercise. Okay, great. I've seen people pay tens of thousands of dollars to own stock that they can't turn around and sell. So you're paying a bunch of money and you never get anything in return, right? So I've seen that happen. Sometimes it's just as simple as everyone's startup is going to IPO, right? Every startup IPOs. I'm kidding. Very few actually do. But that's the thought. Like, it's going to IPO, then I got these options, I'm going to make it rain, right? That doesn't happen that often. So hold the horses. Like, don't be like super jump into exercise if there's no market for you to actually get a return on your money.
Mitch, can you take a moment to kind of explain a cashless exercise then, which happens mostly on the public markets then?
Yeah. So your plan has to be designed to allow it, basically. But the example I just talked about, being too eager to exercise, you're doing a cash outlay, let's say, of money in your savings account, or maybe even borrowing against other equities. There's different ways to finance where you're actually doing a cash outlay to buy the stock. A cashless, more or less, is when you can exercise without taking money from your savings account, but then your net proceeds, if you exercise 100 shares, right, or 100 units, right, there's, well, a couple different ways, but essentially you can get a net proceeds way where you just get less stock at the outcome, or, and then I'm thinking of a private company like Epic, we'll say, they're a little bit different when it comes to this conversation, but they actually have a financing program for you. So your employer very well could offer financing where you don't really have cash out of pocket to make the purchase happen.
Yeah, so you're buying the stock, but you're doing it through a loan from the company to make it happen.
Future liability.
And that allows you to be able to do it. Yeah.
Yep.
I'll jump in quickly with one, I think, too, and kind of almost dovetailing on what Clint said, but if we fall asleep at the switch and we start to get these stock options year after year after year after year, all of a sudden we can wake up one day and we have $500,000 of our net worth, $1 million of our net worth, $2 million of our net worth in one company. We can have concentration risk that just kind of creeps its way into our portfolio and into our overall financial plan. And that can get really dicey for a couple of reasons. One, as Clint said, I mean, there are the Enron cases, not likely, but they're out there. Two is, how do you unwind this position that's now $500,000, $1 million, $1.5 million? That becomes tricky. And the third one is, from a tax standpoint, again, if we're having to try to figure this out when the number has 2 commas in it, because we weren't proactive when the comma area than when number say 100,000, right? A lot easier to plan for those things. So just, I think the one key takeaway for me anyways, have control. These are your assets. You need to have control. If it's something you don't understand, if it's something you don't want to understand, you don't need to understand it, but you need to have professionals in your life that do understand it and that can walk you through it, both from the tax side and from the financial planning side. So this was our kind of first crack, if you will, at equity compensation. I think we're going to come back with more iterations of this topic and probably deeper and get into the weeds a little bit. We wanted to stay more high level on this topic today. So be on the lookout for those future podcasts. And if there's any additional information that you want to see around this topic, please let us know, because we'd be happy to film another podcast that maybe goes in a slightly different direction than this one did. So thanks so much for your time, and we look forward to seeing you on another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.